Think of a bond as a formalized IOU. When you buy a bond, you aren't buying a piece of a company, that's a stock. Instead, you are loaning your money to an entity, usually a government or a corporation, for a set period. In exchange for your loan, the borrower promises to pay you back the full amount on a specific date, plus regular interest payments along the way. To understand how a bond functions, you need to know these 4 key terms. Face value, or referred to as par value. This is the amount of money the bond will be worth at its maturity, the end of the loan. It's also the amount the borrower is technically borrowing from you. Coupon rate. This is the interest rate the borrower pays you. If you have a $1,000 bond with a 5% coupon, you'll receive $50 a year. Maturity date. The expiration date of the bond. On this day, the borrower hands back your original principal, the face value. Issuer. The entity borrowing the money. This could be the federal government, treasury bonds, a city, municipal bonds, or a company like Apple or Ford corporate bonds. How it works in practice. Imagine a city wants to build a new bridge, but doesn't have the $10 million up front. They issue bonds to the public. The investment, you buy one bond for $1,000. The interest, the city agrees to a 10-year term with a 4% interest rate. Every year for 10 years, the city sends you $40. The payback, at the end of the 10 years, the maturity date, the city sends you your original $1,000 back. So why do people buy them? Generally, bonds are seen as safer than stocks. While they don't usually offer the massive to the moon growth potential of a tech startup, they provide a predictable stream of income. The inverse relationship. There's one quirk about bonds that trips people up. When interest rates go up, bond prices usually go down. Think of it this way. If you hold an old bond paying 3%, and the bank starts offering new bonds paying 5%, nobody wants your 3% bond anymore. To sell it, you'd have to lower the price to make it attractive to a buyer.